Good morning, ladies and gentlemen. This is Brad Matheny. Today is the 25th of February. We've got some very big news for everyone this week. The momentum reversal system, the Ment Rotational Modeling system, has rolled into bearish trending. So we have a new trigger for investors and swing traders, which indicates that the SPY has now entered a new bearish trend. Secondarily, I have created a new SPY biasing system, which I will integrate into the SPY cycle patterns and all of my analysis, which has also confirmed this new bearish trending. Overall, what we're looking for over the next couple of weeks is a moderate slide, ladies and gentlemen. We may see that the momentum rally that I was expecting based on the current upward trending in March leading to an April peak may now change. So we need to adjust our analysis to this new trigger. Remember, we follow the markets. We do not try to guesstimate what's going to happen over the next couple of weeks. The pullback that I expected in April may now be taking place as the inflation data shows the markets are weakening. So let's get into this real quickly. Remember, visit Ment.com. I'm making improvements to what we're doing, and I'm getting ready to push out the new TT, which stands for Trade Tank, by the way, one of my websites. I'm going to be pushing out the new 3 MACD intraday system this weekend. Been working on it yesterday and pretty much over the last couple of weeks to get it ready for members. I think it's ready. I'm going to do a separate video on that. But remember, come to Ment.com, check out what I do. I'm trying to provide solutions for day traders, swing traders, investors, and more. Part of my research is the custom index analysis, which helps us gauge and understand what's taking place many weeks and months in advance. I also have the live trades solutions and as well as my other custom index. Now with the new 3 MACD system that's going to be released in TradingView, I'm going to have the ability to help intraday swing traders be able to catch some of these trends. And the new biasing trend that I've created for the SPY may help us identify where opportunities really exist as we continue to go forward. So please visit Ment.com. Come take a look at it. Remember, you get everything in one low price. So you get all of my content for one low subscription fee, trying to keep it as effective as possible to help you guys out. Okay, let's get into the data right now. So the data on this SPY chart is very interesting. I know it looks cluttered, but I needed to go back this far to show you this green line here. You can see it coming off of the highs back in early 2009, carrying over to 2011, and then this blue line, this light cyan line here. Very important that you understand where we're at within this trend system. So as we move forward, remember this is a weekly chart, we move all the way out here. Here is the green line from the highs. You can see it right across here. This is right where the lows in October set up. And here is the cyan line right across here, which is from the lows of the same time frame, 2009 through 2011 roughly. So we have two very critical support levels right here on this green line moving forward, which is going to be around the 370, 350, it's actually 360 right now, but as we move forward, it's going to inch its way up into the 370 area back over here. And then we have very critical support right here at 394.11 from the lows in 2009. Why are these so important? Because a lot of people don't pay attention to these things. They're going back almost 13 years now, 14 years, and we have this very critical support setting up in the market. So we may see this thing roll back around over the next week or two, trying to find support. Even though the biasing mechanism is currently bearish on the SPY, on the daily and bearish SPY on the weekly, meaning that we are looking for a range kind of in this area over the next week or so where support is likely to be found. We could find it in this 396 to 400 area immediately. We could find it down a bit further in the 386, 87 area, or we could see it move all the way down into the 370, 372 area before we end up finding some real support. We'll see how this plays out, but we've got some very interesting moves setting up. Ideally, right now, I need you to pay attention to the fact that this rollover into a bearish trend on the biasing system tells us we need to protect capital. Excuse me. We need to protect capital. That's the move right now. We don't know where we're headed as far as trending. We will see how this plays out. My original analysis of the peak setting up here in early April is still valid. We haven't broken away from that trend yet. We're still looking for this peak right over here in April. But, ladies and gentlemen, we have this new rotation to the downside. It could be a blip. It could be something that turns back around in 4, 5, 8, 10 days, and we could head quite a bit higher in March. But right now, I've just got to report what the data shows, okay? So now, be aware. If I scroll all the way back out again, remember this support level off this blue line and the support level off this dash green line down here. Look at this. We scroll all the way back to 2009. And you can see this is the lows support level across these lows, and these are the high support level off of these highs. These will act as resistance if we get below them. But currently they're acting as support. You can see we kind of stalled off of it here, stalled off of it here, stalled off of it here, stalled off of it here. We could see a broader breakdown if we get below both levels, ladies and gentlemen. So we really have a scenario here playing out, again, right in this area where this little window, this blue window that I've highlighted right here, becomes our critical window, okay? This becomes our critical window for, try to make this yellow. This becomes our critical window for support right now. We really want to see it hold above this 395, 394 level if it can. If not, we have to be cautious of a move down into this lower channel, which would essentially be a fairly solid pullback. If this is an ABC pattern up to here, and we get some sort of a pullback back down into this area, this would be okay because that would prompt another move to the upside, potentially leading to our eventual July rally phase. So we could see this, instead of as I just drew it, we could see this roll downward, form into some sort of support down in this area, and then roll higher as we start a new wave C, because this would end up being wave A, potentially a wave B correction, potentially a wave C, and this could still be all part of wave 1. But right now we are in a bearish bias, a bearish trend. The Ment Rotational Modeling System daily has gone bearish, so we need to move capital away from the markets and start trading smaller amounts as we, as a swing trader or an investor preparing for the next wave and setup. Okay, so now let me come over here and highlight the Ment Rotational Modeling System has now gone bearish on the daily system. So that nets us. We will be taking a new position on Monday's open. I put in Friday's close right now, but I will update this for Monday's open. This puts us into a net bearish position, 50% short, 50% cash, net bearish. We are holding onto this position until the Ment Rotational Modeling System changes. Now let me come over here and come down to here. And this is the actual Ment Rotational Modeling System bearish trigger right here. This is the bearish trigger that's set up in the Ment Rotational Modeling System on the SPY on Friday. Now, as I mentioned to you, 2023 could be a very dangerous year for traders. We need to be aware that the market is flagging, moving into a sideways mode. We need to be cautious. Still, we need to take advantage of opportunities that are there. We're still bullish on a long-term basis. You can see we've just gone to yellow here on the trend modeling system. We can get into pink here. What we need to avoid is a broad downside move. So we need to see probably this 360, 370 area hold up as this, again, this starts kind of an A, B, C formation. Would be okay to see it move down to, say, 370, 372, 374, find a base and a bottom, and then roll forward. But right now, the modeling systems I have are indicating that we are in a bearish price bias. Until that changes, we need to be aware that the bias is now to the downside, and it's not to the upside any longer, okay? All right, let's go back to here and highlight the fact that the intraday signals, the daily I mean, on the Ment Rotational Modeling System have all turned bearish for the most part. Mid-cap is still bullish. We are now at 25% allocation for stocks, 50% cash, 25% metals. Metals are pulling back, and I want to talk about that here in a bit. This looks like a very strong capitulation bottom for metals, so we'll see how it plays out, but it looks like a very strong capitulation bottom. We'll see over the next 2, 3, 4 weeks if this is correct, but I'll talk about that here in a minute. Alternately, if you cannot invest in metals, you would be 25% in your trading account, 75% cash, meaning you're going to protect capital at this point. We're not looking to become overly aggressive in the market with our cash deployment or allocation yet. This is the historical results as of just yesterday, Friday. So you can see the Ment Rotational Modeling System is doing quite well. We're sitting over here at near all-time highs. We've had a little downside move here over on the edge, which is fine. We're holding up very, very well, while the S&P, in fact, I read an article, most traders are down 25 to 30% this year in their retirement or investment accounts, whereas the Ment Rotational Modeling System has performed exceptionally well as we move through this. Now, we're taking a little downside pressure right now, probably about 1 or 2%, but that's normal. Remember, as you see here, we will fluctuate up and down, you know, maybe 6, 7% every quarter on average with regard to risk, whereas upside averages are probably around 7, 8, 9% every quarter. And you can see we've had, you know, a number of potentially losing quarters, but year over year we've been very consistent with the Ment Rotational Modeling System. Okay, so you have been updated. We are now bearish. Remember, we are now in a bearish cycle trend. You need to be aware that this has changed, and let's go ahead and go through the custom indexes. So, first thing we're going to do is take a look at the accumulation phase index. This is the SPY on a monthly basis. We are still holding up in this bullish type of a pattern, this lower channel. As I mentioned to you many months ago, we need to see this stay downward in this lower channel. You can see we're moving in this downward cycle. We could see this resolve back into a bullish trend over the next week or 2 or 4, who knows. But technically, we're not seeing a big breakdown. So understand, we've moved into a bearish bias trend, but we're not seeing a big breakdown. And as I go through the charts, I'll talk about what I've been highlighting going forward, particularly this one, the cash flow index. So I highlighted how we had gotten back up into this trend, and I wouldn't be too surprised to see it move back down into this 130 area, 127 area, trying to find support. Guess what happened last week? We're moving back to the downside. We're looking for additional support. I still believe the U.S. economy is strong. I believe the Fed has moved rates efficiently. I believe the Fed will move into a pausing cycle I believe the index data, the PCE data that came out on Friday that kind of shocked the market, is lagging. I believe that this is actually moving downward based on the data that I'm seeing. But I do believe that the markets are struggling and will struggle, as I've told you, through most of 2023, and the second half of 2023 will probably be much more opportunistic. So right now we are doing exactly as I predicted, moving to the downside. We'll take a look at some other charts that show you how much risk is involved. But in theory, ladies and gentlemen, a 50% retracement or so of this level would put us in this 123, 124 area. Another couple weeks of downward trending that may set up a new upward trend. The consumer engagement index is stalling, hasn't really collapsed. We only have a couple days left in February. I think we're going to see it stall out in this area, maybe move a little bit lower in early March and then try to find some support. I still believe we're going to see some upward trending potentially in early mid-March and leading us into some April 10th, April 15th peak. But like I said, I'm reading the data as it's coming out and trying to provide the best information I can for you. So consumers have again, somewhat re-engaged, but kind of stalling out right now. The custom valuation phase, this is an older chart. The large cap index monthly is holding up okay. Large caps are actually finding some sort of a base. This would be the first double white candle bar that we would see in many, many months since back over here or back over here. We haven't seen two white candles in a long time. If the large caps hold up through the end of February, this would be a pretty good indication that we might be basing and moving into some sort of a reflation cycle later in 2023. But large caps are holding up here in February while the markets have rolled over a bit. So this is actually a fairly positive bottoming sign setting up here. Global asset index, same type of scenario. Two white candles. You can see we haven't had a whole lot of support here in a while. We need to see this hold up. This is a pretty good bottoming cycle as well. You can see the RSI has moved higher and stochastics is bottoming. Historically, stochastics down in these extreme levels, this was skewed because of this high up here, but down in these levels, once we start to get basing and bottoming, we might be 6-7 months away from a new kind of an upward appreciation channel. So we may be very early and looking at a July, August, September type of early appreciation cycle. The gold cycle index is showing consolidation in an accumulation phase. Gold again could be capitulating down near this level. It looks very interesting for gold to set up kind of a deep base like we saw with COVID. We've seen a pretty broad pullback. Could be a fairly strong rebound move to the upside, getting back above 1870, 1875 again, and then stalling out as we let the market settle. But we'll have to play it as it goes. Right now, though, we're seeing very solid accumulation down in this area. We just need to see what happens next. The innovation index has stalled out. This is kind of what I suggested. If the SPY bias trend change to the bearish side works the way I expect, we will see this move back down into the 60 area, maybe 70, probably 60, 59, 60, 62 area, right in this middle channel, kind of where we were back over here, and then try to find some support. So look for technology and the general market to pull back off of these reflation trades set up here. You can see this upward move. I expect it to pull back about 50% down into the 60 area and then try to mount another rally, I would expect. I would expect by the time we get into end of March, we're going to be looking forward to Q1 earnings, and that's going to put us in a whole new environment with regard to what the economy is doing and what our expectations are going forward. The custom fear index has moved a bit higher, 6.47. not moving into extreme fear levels yet, but higher. So this tells us we've got some increased fear in the market. You can see the downtrend in the SPY here, still in kind of a super trend buy mode. But just like I told you with the market sentiment index, we got up into this middle area and rolled downward. We could see consolidation for the next 30, 60, 90 days within this green channel, possibly staying, below this 381 over here, and staying really into this kind of a channel area, which would mean we'd have a 6, 7, 8% rotation in the SPY, just kind of flattening out as we move into potentially June, July, August for a bottom. So everything that I've been warning you is playing out. The new signal, the bearish signal, tells us that we've now exited this upward trend cycle here, and we're now setting up a pullback. Some type of a pullback or a new trend. I'm expecting a pullback, these lows to hold, as I mentioned to you, but we'll see as we go. Fear levels moving a bit higher. The last thing we want to do is see this thing start to spike upward. That would indicate that we're moving into a new downward cycle, which means we'd have an A, B, C downside move. Could happen, ladies and gentlemen, but we need to see if there's some catalyst that takes place. Next, we have the real estate index. Very hostile still. Real estate is one of the things I think everybody's overlooking. This tells me that we're going to be moving into a downward cycle trend in real estate. I believe it could be a bit more dangerous, but I also believe that the Fed is well aware of the dangers related to this cycle and what they've created. So we'll see how it plays out. But overall, we've never seen these levels. These is the most hostile, extreme levels we have seen in more than 2 decades. So be aware that a reversion to the downside could mean an extended decline in real estate, possibly lasting 2 years or longer. Custom technology ratio index stalling out a little bit, had a good solid basing and bottoming. I still think that this moves just kind of into a sideways channel until we settle into what I call a reflation cycle, which I believe is July, August, September, where we start to see upward trending. But again, we could get some volatility in this area. We could potentially get a deep low moving downward if the markets break to the downside. But right now, we don't have any sign of that yet, ladies and gentlemen. What we have is a clear indication the markets are consolidating, pulling back, moving into a bearish type of a trend phase, which is kind of like a pullback in this upward trend. Let's see if these lows hold, and let's see if the markets can position for the June, July, August base bottom I expected. Okay, U.S. global to global index. This is the U.S. This is the global index. You can see we pulled up and now we're pulling back down. They're moving in unison, ladies and gentlemen. So we're getting a fairly strong global reaction to global market concerns, which is more than likely related to the continued unwinding that's taking place. I believe we've established the double bottom here. You can see off of COVID. We had the U.S. market hold up just above the COVID highs. I believe we are going to stay within a sideways channel on both of these. Struggling to try to find some support and moving into the June, July, August base bottom. Next, the U.S. Valuations Trend Index. Okay, the Valuations Trend Index is moving decidedly downward. You can see this here in February. This is an inverted chart. This is downward cycle trending. You can see we've had higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. I do believe this level is going to hold up. If we get below this level, we could see a move all the way back down here to the to this level, which is essentially 370 or so, right over here, 363. But again, that would indicate that we are in a deeper downward cycle, and we would be looking at the 363, 365 level as one base bottom potential, and secondarily we'd be looking down here at about 497, which would be this bottom basing level. So we have to be cautious, which is why I'm advising you to reallocate your money move some back into cash, be prepared in case there's some breakdown in the market. The rotational modeling system is doing its job, telling us and warning us that the markets have potentially changed direction back to the downside right now. Next, the U.S. leading index has moved downward. You can see this is really, as I mentioned to you, when we get up above this channel here, we're kind of in a bubbly type of a territory. So having this pull back down into this area, this 1.8, 1.7 area, is healthy. We need to see this kind of stall out, form a base or a bottom over here, and move away from this bubbly type of activity. Ideally, I would love to see this move down to 1.75, 1.8, find a base, find a bottom in June, July, August, and then start to just channel like we saw back over here. Channel into this area with the SPY moving into an upward trend. This would be a healthy, organic type of growth. This type of activity is essentially unwinding of price excesses. I believe we're going to move down and try to find support down in this 50% retracement area, but we need to be cautious of a big breakdown. We do not want to see it happen over the next couple of months. It would set up a big capitulation bottom if it did happen. Next, the volume ratio chart. Oh, I forgot to update this, so I'll have to update this. The commodity to gold ratio index is stalling back out. This is healthy. This is telling us that we're getting into more deflationary trend related to gold. Deflationary trend is good. That's what the Fed wants. It may move the Fed into a more dovish type of scenario. I believe the Fed should be pausing maybe one more 25% rate increase, but I believe the Fed should be moving into a pause, wait and see, related to the lag time effect taking place by these recent rate increases. The one thing they don't want to do is go too far too quickly. They need to let everything kind of settle. And again, real estate looks really, really rough right now. Okay, the metals trend index is moving downward. And again, you can see we've come right back down to this 50% level. You remember when we were coming up over in this area, I was telling you I expect a pullback. This is getting a little extended on this gold move, and now we've had the pullback. So if we have COVID right here, you can see that COVID had basically let me do the math real quick. So about 9,900 down to about 8,400. That puts us about a 1,500 point pullback. And now we've gone from, say, 12,500 to 11,400. That's a 1,000 point pullback. We might see a little bit more of a downside risk here, but I believe this could be kind of a capitulation bottom. As gold is pulled back here, this could very well be selling of metals, just like we saw over here. Selling of all assets took place when COVID hit. Then you can see how gold rebounded, rallied up to new highs. We could see the same thing happen here between March, April, and May. We could see it come all the way back down, rally back up to gold, particularly about 1870, 1920, stall out a little bit, and then move back up here to new highs. That would be a very good capitulation bottom for gold. Okay, gold and silver could be a good little pop right here if this ends up being a bout of capitulation lows taking place on this CPI data. The real news is going to come when we get into Q1 earnings, after March. When we get into April, May, June, we start looking at what the economy's doing, start moving into summer months, seeing what the consumer is doing, how jobs are doing. We'll start to see what actually is taking place. The inflation data continues to show weakening inflation. So that's actually healthy as we unwind. Consumers are still strong. Jobs are still strong. We need to see some unwinding take place, which is why 2023 is going to be a very difficult year for traders and investors. Stay aware that we have a lot of volatility ahead. The FANGs index is stalling back out. Again, the data has been doing this for months. I don't know why, but it is what it is. we're getting into this stalling type of formation. We could see this move right back down into this 275 area trying to rebound. And this is fairly good organic trending here. We need to see this kind of just move into this lower channel and stay there in an upward slide. That would be very healthy for the technology and innovation sector. Here's our base metals index, shows us the pullback in gold. You can see the same thing happen back over here with COVID. And like I said, this could very well be a kind of a capitulation move as fear elevates. So be aware that we have support down here in this 411 area, pretty much where we're at, right in the middle of this apexing pattern, and right where we broke out right over here. We do have ultimate support down here on this green level. We could see it reach an extreme low. It would be kind of like this COVID move right here. You see how it came down, hit an extreme low, and then rebounded back up. That would be a capitulation bottom type of a move. We saw the same thing kind of happen here. Came down, hit capitulation, stalled for a bit, then rebounded. Same thing here, same thing down here. This was a bit more extended near the end of 2022, but we could see kind of a pullback down in this area, which would be a great opportunity for traders. Be potentially a capitulation low, and then metals could skyrocket back higher over 4 or 5 weeks. We just need to be aware of what's actually taking place in the market. Next, the smart cash index, which is I've kind of gone over. We've come back into this gapping area. We do need to see this hold, hopefully above this low right here. So we're going to be 142, 144 area. Ultimately, it could come down into this area and still hold, which would be about 136, 137. But this was a huge reflation trade with a decent pullback. So we need to be aware that we are in a downward cycle trend, which may lead to a late March into mid-April peaking pattern. So we'll see how it plays out. And here we've gone through these. Okay, the real estate modeling system. I'll go over this briefly. This was updated as Thursday. Model market demand is 19.76. Real pricing factor is minus 21.49. Demand has come back up. There are still people buying, but you can see days on market has skyrocketed. Prices have now moved down to near zero. So we're getting year over year pricing data very, very low, folks. That's why I think demand will stay moderately high, but pricing is going to start to contract. You can see that we have price reduction count at about 150%. You can see here active listing count is kind of stalled out. I believe this is going to move higher as more homes come on the market. And like I said, it's looking fairly ugly. I'll show you why. So price reduction activity is 147. It's looking very ugly. Active listings have consolidated a bit. Pricing trends have inched downward. I think you're going to see this move into a broad downward cycle over the next 12-15 months. New listing count metrics have shown that we have a new listing counts are at 67%. New listing count change last week was minus 0.21, and new share of market is 0.39. That means this is the share, the change as of last week, whereas this is the current reporting value, plus 67%. Highest active listings we've seen in more than 3 years. Okay, heat rank. Heat rank ticked up back into zero after being very low heat. That means that we had some activity last week. Tightness rank has gone to minus 100%, meaning that the market is pretty much the bottom, I believe, is falling out of the market. Inventory strength is collapsing again. I believe this will move down into minus 10, minus 7 to 10%. I believe this is going to be another wave of big price decreases. And look at seller desperation. Biggest number we've seen in 4 years. Seller desperation, 126%. That means sellers are actively decreasing prices, doing anything they can to get buyers to come in and take their property right now. So Once the tightness starts to fall, once the bottom falls out of the market, you're going to see this really start to accelerate. You're going to see the heat rank start to collapse, I believe, kind of like minus 15, minus 20%. And you're going to start to see seller desperation skyrocket as sellers try to get out at the best price they can. Okay, U.S. stock market index moving downward again. We need to see these channels hold up. I do expect this to continue to move higher. I don't believe these lows will be retested, at least at this point. We'll see what happens. We could move into a wave B correction down in this area, or we could move into an A, B, C downward move if some catalyst event takes place. And real estate could be that catalyst event, which is why the Fed needs to start addressing concerns and letting the market settle. But again, right now we have got an early warning bearish stage. We don't know where the market's going to go. I believe my analysis from early this year is correct, indicating that we're looking at some sort of a base setup here with a resolution back to the upside, leading into a mid-March to a mid-April rally, a mid-April peak, and then rolling back over into a sideways phase, which should potentially base and bottom somewhere in June or early July. Next, we have the valuations index moving downward again. Perfect. We want to see this. We want the Fed to notice that inflation is subsiding, and we want the Fed to potentially pause. We want the Fed to become less aggressive in terms of trying to address concerns, because we don't want the markets to break. Nobody wants to see the world enter into a massive decline because something went wonky. What we want to do is just let everything settle. This deep decline in valuations is very, very healthy. And lastly, the volatility index, just as I indicated, we have broken this channel. We've moved into bullish trending. We've kind of reflated right through this area, and now we're coming back down. We could see this move back down below 8, just like I told you last week. We could see this downward cycle trend try to reestablish a new base, maybe 6.5, maybe 7, maybe 8, and that's very likely now that the bias has moved to the downside. So we have a very solid, probably 3 to 5 weeks maybe, into the middle of March, I would assume. If we're not seeing some sort of a new rally phase by March 20th, March 25th, then we could be looking at more of an extended downside move. But I'm still holding on the basis that I believe we're going to see a rally phase into March and into potentially April. And it may be that some foreign catalyst is taking event. It may be something else is driving, but I believe the U.S. dollar is going to move up to 107, 108, try to hold around 108, maybe 108.5 between now and, say, June. And I believe the strength of the U.S. dollar could indicate that we have weaker foreign market trends. So understand, we may be moving into something where global markets enter into some sort of a crisis phase, and the U.S. markets become a global safe haven, which could prompt another flight to safety into U.S. equities. So we will see as things move forward. Okay, guys, remember, come to Ment.com, check out what I do, share it with your friends, pay attention. I have a lot of new things coming for you. Day trading tools, swing trading tools, investment tools. My goal is to help you become a better trader and learn how to take advantage of these big market trends. And again, share it with your friends, and please come and support my research if I've helped you earn any money or protect your money efficiently. Very inexpensive to get started. I'm trying to keep it as inexpensive as possible. All right, guys. Talk to you soon.